Hey, Shane, how's it going?
It is going well, my friend. It is going well for people who are holding lots of cash and maybe even some short exposure in their portfolios. So that would include me and all of our clients here at Elevate. So
hmm
that's pretty cool.
It does feel good. And I just did an update. So the 60/40 portfolio as of today, right before this meeting, was down year to date 21.6%. So not really doing what we would hope.
Was
The
that
diversification,
is that using LQD as your bond proxy, the investment
it
grade
is.
corporate bond ETF?
It is.
So I'm going to add that real quick to this list here, and I'm going to zoom in just a touch. So this yellow line over here on the left-hand side of my chart. And by the way, I'm going to actually get my little spotlight tool out so people can see what I'm pointing at a little better. But this yellow line here is December 31st of 2021. So that's the beginning of the year for both this blue area, which is the S&P 500, and the orange line, which is your LQD liquid investment grade bond ETF. And you can see that the bonds for the year are down 18.56%, and the stocks are down 22.8% and falling hard. So yeah,
Yeah.
if you had 60% of your money in the blue line, right? Then you had 40% of your money in the orange line. You are getting smoked this year in your pie chart prism portfolio, and that is like the majority of the American population that is in this exact portfolio. 60% in the blue line, 40% in the orange line, both getting crushed together.
Absolutely. And for reference, so today's June 16th, by the way, so forgot to get that out there. But we had the Fed meeting yesterday, and they're the ones with the bazooka that can save everybody, or in this case, knock the net worth of everybody down a bit. What are your takeaways there?
Well, you moved on a little bit too
Oh.
quickly for my liking. I want to go back to this chart on your screen. I mean, why is it that so many people are in the 60/40 portfolio? And what's and you can tell, you can answer this question. It's not a hard one. This is a layup for a guy like you. But normally it doesn't look like this. Normally 60/40 is meant to be a diversified portfolio because they don't look the same. So why do you think so many advisors just put people in a 60% stock and 40% bond portfolio and then totally forget about it for the rest of eternity?
Well, that used to work really well. As you know, in the 80s, you could have bought a 30-year treasury for 18.5%. And the bond price moves inverse to rates. So that would have been a great time to implement that portfolio. But times change. And
Yeah. Yeah, I think a lot of the a lot of the investment management advice population, bases everything they do on historical correlations holding, right? And that means that, correlation just means what does one thing do when the other thing does this, or does something zig when the other thing zags, or do they both zag at the same time, essentially? And for all of my career until very recently, and for most of everybody's career in the investment management business, unless they were managing money back in the 60s and 70s, right? Which there's not a lot of guys who are still around managing money that were managing money then. Um, they look at historical correlations going back to the 80s, and bonds have been consistently, doing well since then, and rates have been consistently falling since then. And so bonds were a great diversifier to a stock portfolio. But over the past several quarters, those historical correlations have totally broken. Um, Bonds are not inverse to stocks anymore. As the Fed embarks on hiking interest rates, and the market overall sells bonds and forces interest rates higher, these historical correlations are no longer inverse. And so the bonds and the stocks are moving together, and the things that used to diversify you don't anymore. And I the investment advice community simply is not paying attention. Like,
Mhm.
by and large, they are asleep at the wheel. Um, it's not their money, it's their clients' money that they're losing. And it's just shameful that they can't figure out to hold some cash. I mean, I don't understand why they don't do it. Um, I mean, I guess I do, because they don't typically charge fees on cash, and when cash is in somebody's account, people tend to spend that cash on something. So, it's a survival mode for most of these advisors to just talk to people about their emotions and keep them on the roller coaster for as long as possible so they can keep charging their asset management fee. But this whole pie chart of stocks and bonds and maybe some alternatives, if I threw real estate on here, it's down for the year too. So I mean, there's nowhere to hide right now except in cash. And so I just think it's really important to talk about that. 60/40 portfolio is never supposed to be down more than 20% for the year. And you said it's down what now? 21 essentially?
21.7, I think. So, and just historically, so World War II, war bonds, that was the big investment. People didn't really own much for equities. And it really wasn't until ERISA started implementing 401ks that Americans really held equities. So when you look at the historical data on this 60/40 portfolio, it's limited in a way. This hasn't stood the test of 100 years.
Yeah, it's
So
brutal, man. Brutal. So anyway, all right. Let's stick with the SPY here. So what you see on the screen is this was December 31st of 2020 to December 31st of 2021. During that time, the market, as we know, last year went up 27%. So the S&P 500 was up 27% for the year 2021, and at Elevate, we were just in total disbelief. There was no good fundamental economic reason for that to be happening. The only reason the market was going higher was because the government was pumping money into the economy. It wasn't because the businesses were doing well or the economy was doing well. It was simply recovering from being totally shut down in 2020 due to a virus. And so what has happened now, as you can see if you're paying attention, the market has more than erased all of its 2021 gains. We're now below this yellow line here, which represents where the market opened in January 2021 or closed in 2020, however you want to look at it. And so we have now more than erased 2021. We're now 1.68% below that. And anybody who hasn't followed their trailing stops or some type of stops has erased their gains for the year too. Bonds don't look much different. So I think I just think it's important to note that, like, when we look back at, say, November to December of 2021, that'll end up being the peak of this bubble, just like we can look back at October of 2007 as the peak before the financial crisis. And that bubble peak could remain in place for a very long time, longer than anybody else thinks possible right now. And so the market is just very clearly in a downtrend. If I change this chart to, say, candles, so we can get 4 data points per day instead of just the closing price per day, we can draw all types of lines, right? But if we draw one just here, we got a long ways to go to get back above that trend line. If we take this and draw another one here, we've got a long ways to go to get back above that trend line. And if I want to add the 200-day moving average and the 50-day moving average, everything about this just looks totally bearish. And getting back to the question you asked me before I was ready to move on, is the Fed just raised interest rates by 75 whole basis points yesterday to try and get inflation under control. And the current Fed funds rate is at a whopping 1.5%. So I don't think they're doing enough to get inflation under control. What do you think that they're going to have an impact in the near term, or how do you see it playing out?
it's such an interesting question. So if they're trying to maintain 2% as the real rate, and we just printed 8.6, we have a long ways to go to get up there. So we need to be up at 6.6. And it's terrifying. I don't know how, as a government, we can raise rates too much, because then we have to pay the interest on a mountain of debt that we have, and raising that much just, I mean, come on. That's like me going on a diet and just cutting out a Snickers bar.
Yeah, right. Yeah, the market just has a ton of work to do to get back to any type of level that would indicate that we're back into upside momentum. I mean, I think maybe around there, and it's just got so much work to do. If I look back at you guys will see this headline if you're paying attention. Every news outlet in the world is going to run this headline that says, "Oh, the Federal Reserve raised interest rates by 75 basis points for the first time since 1994." That's what you're going to hear if you pay attention, because everybody's going to print that headline. And so the last time that they did this was in basically October, end of September 1994. Let me see if I can get to it daily. Oh, of course that's going to happen. Sorry. Let me get back there. We got to go way back a ways to get to 1994 on the daily. Hold on
And
here.
set the backdrop for me, Shane. 94, were we in a, GDP expanding in a
Hold on,
growth cycle? Or-
I will tell you in just one moment. But what I want you to see is, let's see, where were we? It was right around here, end of October. So if I draw a little line here, right, end of October, they raised interest rates by 75 basis points. And the market dropped before starting to rally, pretty nicely from there. So I thought that was pretty interesting. But here's the deal: is by the time we got to right around March, April of 1995, they had started cutting interest rates again. And get this, if I look all the way back, let me get these moving averages off of here. If I look all the way back to answer your question, Kyle, what were rates at that time, right? This is the hike right here. That's the 75 basis point hike. So that big jump right there. So on that day is when they raised it. And at that point in time, interest rates were over 5%. I wonder if I have CPI. So if I go and look at what CPI was, now that's probably not the best place to look at it. GDP. There we go. 1994. No, I don't follow you on Facebook. So GDP in 1994 was growing at 4% year over year, and for the full year, it grew at 4% for the year of 1994. So looking back here, they raised by 75 basis points to get to 5.25, call it, and CPI was only at 3% back then. So inflation was at 3% and the Fed funds rate was at 5.25. Think about that. Today, CPI is at 8.6% and the Fed funds rate is only at 1.5. It's totally inverted. And at the same time, GDP is slowing today. In fact, GDP declined in Q1 of 2022. So who cares that they raised rates by 75 basis points last in 1994? It was a different world back in 1994, and a 75 basis point rate hike today to only 1.5% Fed funds rate. Look at where we are.
Yeah.
Look at how much lower we are. It's
And-
madness.
And that's been the big thing, is that then we were having a rate hike cycle into positive growth. The markets were doing good. They wanted to just dial it in a bit. And now we're in this situation where the Fed just waited so long, and now we're raising aggressively, and relatively speaking, compared to a 0% rate that we started with, and we're doing it in a negative GDP environment.
Yeah, it's not good, which is why you see the market reaction that you see today. And so yesterday, while the Fed was talking, I sent this chart internally to Kyle and Ken, and I wanted to highlight that the last time the Fed hiked rates and Powell had a press conference was here on May 4th. And the market rallied. You see that nice big green candle? Market was rallying for a couple of days into May 4th. And then on May 4th, the market went up 3.05% just in one day. And everybody was getting all bullish. You know, the market closed above the high here and above the high here. And the next day, the market dropped 3.55% all in one day. So from being up 3.05 to down 3.55 in one day. And from there, right, I'll call it from the peak to the next bottom was down 11.32% or 10.23% if you want to use this day before the market popped a little bit. So fast forward to yesterday, which is here, FOMC and Powell press conference. Again, the market rallied. It only finished up 1.43% for the day, but off the lows of the day, market was up 3% yesterday. You know, from bottom to top, excuse me. And so far, you know, since the close yesterday, we are already down 3.17%. We were down a little bit more, so market bounced a little bit off the lows, but the NASDAQ, man, NASDAQ is down almost 4%, was down 4% at one point today. So just, it's ugly out there. Nothing that Powell said in his press conference yesterday was bullish. I mean, nothing. The guy didn't say anything that would lead me to believe that, you know, the market's going to do better over any time frame. He basically said, you know, don't plan on a soft landing. Last time he was talking about, oh, we're going to be able to thread the needle and raise interest rates without crushing employment and without causing an economic recession. And in his press conference yesterday, he basically said, I have no confidence that that's actually going to happen. So it's terrifying, you know, from that perspective. I think things could definitely get worse before they get better. And you know, if I were to zoom out, actually, I'm going to go back to this screen. But if I zoom out here and go put our line back at the highs pre-COVID, so how was the economy and the market doing before COVID hit and they shut down the entire global economy? That gets us to about 339 on the S&P 500. And from where we are today, that would take us about 7.6% lower than where we are today. That would be a 29% drop from the highs. And I think at that point, you might find some more buyers. But if the Fed is still tightening into a slowing economy at that point, there's no reason that it has to stop going down there either. You know, there's some levels here that you could look at after that. And then, you know, if it doesn't stop there, all the way back to the COVID lows is not out of the question. I mean, nothing is out of the question in an environment like this. If the market goes down into this area, the Fed will end up loosening. They will stop tightening monetary policy, I can assure you. Unemployment rates will be very high at that point. Inflation may or may not have come down materially since then. But I can bet that if the market gets down to this area, they will be backing off of their hawkish policy, and that will give us an opportunity to be buying stocks at a better price with an easing Fed. So yeah, it's not a pretty picture out there, and I feel bad for people who are getting squeezed by higher energy and food prices and their wages aren't keeping up. I'll tell you what, before I let you say anything, the one thing that really bothers me is that nowhere in the Fed press conferences and nowhere in the media is anybody talking about how the Fed is responsible for this inflation. Like, they printed the money. They bought the bonds, they continued buying bonds all the way. They were buying bonds in March of this year, like to the end of February. They were still buying bonds. They were still easing monetary policy and calling transitory or inflation transitory. They knew that inflation was a problem all the way back here in September and October, but they didn't do anything except for start to taper their bond purchases. It's so irresponsible. So to depend on the Fed coming to save us from the situation that they created is, you know, it's like depending on the arsonist to come and fight the fire. It's just ridiculous.
Absolutely. And unless you prescribe to MMT, which is, you know, modern monetary theory, and I think this has proven that that does not work. I don't see that the Fed's going to come out and just print tons of more money and somehow solve this situation we're in. And the other thing, Shane, it sounds kind of gloomy right now looking at all this, but if you're somebody that's that 60-40 portfolio or sitting in a bunch of funds, uh, don't go out and take this as a call to action to get out of that. Call a professional and
Yeah.
navigate out of it strategically. You don't want to be the person that sells right at the bottom only to watch it rally where you could have got out at a better position.
Yeah, no, that's totally true. And I don't know that I would ever want to be in a 60-40 portfolio again for a very long time. These interest rate cycles tend to last a very long time.
Yeah.
So I think the interest rates can rise for the next 30 years. So bonds are dead money if that's going to be the situation. I mean, I don't have any guarantee that that will happen. But if interest rates rise, from 1946 until 1980, interest rates were rising. And since 1980, 81 till now, interest rates have been falling. So these cycles are multi-decade cycles. And if interest rates are really going to continue to rise, they could do so for a long time, in which case you would not want to be long bonds.
No. And
And
I
yeah,
think there's spots,
go ahead.
personally, show me a 10-year rate at say 8 to 10% somewhere in there. I'll grab some. Down the road, that might not be the worst place to be. Earn a little bit of yield on that. But yeah, right now, just from a market timing standpoint, I don't like buying any of this. I mean, you're about to show me the chart here, but
Well, this is the 10-year rate. It only goes back to 1994 on whatever I'm looking at. So it was higher than that, in the early 80s. But what is, I guess that's 7.6%, not 76%, just like this is 3.335%, not 33.35%. It's just a little bit weird the way that they do it on this particular chart. So yeah, like you said, I wouldn't go out and panic sell anything, but I think I'd be looking to work my way out of that portfolio over time and get into things that are holding up better. There are some things that are still holding up quite well in this market, and so it's not like you need to be 100% cash. But I would just definitely say you want to hold a lot more cash than you normally would in an environment like this, and certainly wouldn't want to be 100% invested in a 60-40 stock to bond ETF or mutual fund portfolio. No need to pay fees for something like that anyway. You could do that by yourself.
mm-hmm.
And pay nothing to a portfolio manager. So if that's all the portfolio manager is doing is building you a pie chart of funds, you can save yourself like 1% or more a year just by learning how to click a couple of buttons, which is no big deal.
Absolutely.
Yeah. So anyway, next on the list, QQQ. You want to look at that one? I don't know. Pretty much
Yeah.
hit this stuff pretty hard already. So I don't
Pretty
know.
much on the same. What about, within QQQ, Apple? Do we want to flip to that or do we want to go in order here?
Oh, we can look at
Take a
Apple.
look. And we talked about 138. That was the level, wasn't it? So we're now below that. So it looks like it tried to bounce on that level and tried to hold it and does not look like it wants to hold it anymore.
Yeah, that 138 level had been in place for quite a while. So I just make it exactly 138. So I said I would short it. I never did short it. I was too busy shorting other things, but I'm glad I didn't short it right here because that would have been the wrong thing to do. It went down a bit and then bounced, bounced what, almost a little over 9% from the lows at that point. But same idea here is like when this thing breaks below 138, you could have shorted it right here and put your stop at 138 or close above 138. You would have been risking very little. And, since it dropped below 138, it's already down another 5%. Who knows how low this thing could go. I was looking at selling a $100 call or put options the other day, which would obligate me to buy Apple at $100 a share, which is right at the bottom end of this gap pretty much, and is a good bit down. So I don't think Apple would drop 22.8%. And if it did, I think you'll find a lot of buying support down there. So we're in no man's land right now. We're dropping, we're breaking support levels with negative momentum, and it just doesn't look good. Apple's one of the best companies in the world. I don't think they're going to go bankrupt. It's not a bad place to be invested. If you've been in for a long time, you probably haven't even hit your stop on this stock yet. So, you know, you can get away with holding things like this for a while, but if you have a stop, and let's say from the highs, you know, Apple usually experiences say 30% volatility. Well, you're getting pretty close. I mean, 127, 128. If it closes below there, I think you gotta sell, and you gotta look for a new opportunity to get invested. If it go, I shouldn't say if, but when it goes back up again, because again, this thing is just in a downtrend. So, you know, if I stopped out of it, I would set an alert when it goes back above this downtrending line and maybe think about getting back in. So Apple earnings coming up July 26th. So we will see what they have to say. I have a feeling they're gonna cut their guidance just like everybody else. And if people aren't planning on that happening, could be a nasty surprise when earnings comes out at the end of July.
Absolutely. And then, you know, maybe now let's turn just to the macro side. So, you know, oil and gold, we always talk about those.
Yeah, I feel like you should pull up your oil chart. You got the nice big arrow, but the arrow's finally starting to break down a bit. I haven't drawn any lines on the oil chart in a while, it looks like. So do you want to pull yours up, or do you want me to draw some lines on mine?
We could draw some lines on yours, and, you know, something, so I was struggling a little bit, and I don't know if your chart shows it, but we rolled to the next oil contract. So there was a bit of a false sell-off. So I don't know if TradingView adjusts for that.
Yeah, this is the constant maturity. So it doesn't show the gap, I don't think. So, I mean, this is the accurate price as far as I know, 115.36, and it was down quite a bit more earlier today. But yeah, so now we've kind of built, you know, a new little wedge here. We've got a lower high that we reached here, you know, around June 10th. I guess June 14th, so just a couple of days ago. And this area here is probably the low end of the range for now. So I could easily see it bouncing along in this region for a while and then picking a direction one way or the other. Which way it will go, I have no idea. But we're holding above the 50-day moving average at this point, and the 200-day moving average is way down here. So again, oil's up a lot. It's still in an uptrend, still above all the major moving averages, but we're seeing a little pullback. So if you've been looking for an opportunity to get long oil or oil stocks, this could be the moment. Not saying that you go and catch this as it's going down. You wait for it to bottom and start rising, and then, you know, you want to buy it on a breakout from this range is how I would trade it.
Absolutely. And, you know, part of my thinking when I was looking at it just fundamentally is we're in this situation now where you've got the Feds kind of giving us this gloomy forecast for growth, but then also with rates going up, could create an environment where the demand for oil might take a little breather. You know, we'll see on that. I'm not an oil expert, so I just defer to the chart, but I think you hit it.
Well, and I see down here too, I see the momentum starting to decline as well. So, you know, when that shifts to red, it's usually a time to at least take some profits off the table. I probably wouldn't be shorting it here, but yeah, I mean, there's a couple of ways to draw, you know, shorter term charts. We're now below that one, so I think we could easily end up down here in the 107 range, or maybe even down to 100 before it finally stops going down on this run. And again, I mean, the big deal is that as long as oil stays above 90, I probably can even go lower than that. All the companies in the XLE, the energy ETF, all the big oil stocks, they can continue to just make really good profits as long as the price of oil stays relatively high. So again, these companies have fallen, you know, 15% from their peaks just a few days ago. I guess about a week ago now, but that's a meaningful pullback in a larger uptrend. And so if you've been looking for an opportunity to get long the oil or oil producers, you know, could be getting close to time to take a shot at some of those.
Mm-hmm. I agree on that one. Then here's gold. So it's kind of looking, I think, a double bottom on the daily. It might be basing to go higher. Again, this is just one, there's better trends if you're ever going to trade it. But it does look like a bit of a base here, and maybe it could work its way higher from there.
Yeah, I mean, when I'm trading something like this, I always look for, the higher low to as something that might be a trigger. So it dropped all the way to a low here. I put in a higher low here and is now rallying back above the 200-day moving average. So it's a good opportunity to maybe consider, but still below the 50-day moving average. 50-day moving average is falling. If I draw a line up here, we need to get really back above this level, which corresponds pretty well to the 50-day moving average. I think before you're, kind of got the all clear to take a long shot there. So yeah, I mean, again, gold is a great chaos hedge. It's a great inflation hedge. It protects your purchasing power. But when people sell everything, they sell gold too. So there's
Yeah.
no guarantees.
And for me, that's been what's in my mind is three things. Strength of the dollar, which I see your dollar chart coming up. Usually if the dollar's bullish and going higher, that hurts gold. That usually corresponds with higher interest rates. Again, not great for gold. And then just the last one is if people, if we see the market just start tanking and you get margin calls, that's that third factor that could hit gold. So I don't want to overanalyze that one and try to just defer to that chart, but those are three things that I'm mindful of, and they're not exactly bullish for gold, but it's also relative. So relative to everything else, if gold looks good, might be where money goes.
Yeah, and I mean, in our long-term portfolios, we use gold as a chaos hedge. So it hedges chaos better than anything, And so if there's a lot of chaos in the market, gold is a kind of a port in the storm. I once heard somebody say that, gold is not even an investment. Gold is a conscious decision not to invest. It's the one thing that for thousands of years has been money. It's money, for a bunch of different reasons, but um, gosh, I need to find this one chart that I have. It lists the five real reasons that gold has been used as money. Let's see. So it's scarce. It's inherently scarce. No human needs to make it scarce. Gold is just scarce by its very nature. It's fungible, which means that 1 ounce of gold is 1 ounce of gold is 1 ounce of gold. It doesn't matter if you get the same 1 ounce of gold. There's no difference to them, right? It's scarce. It's fungible. It's divisible. So you can shave off a few a few shreds of your 1 ounce coin if you need to buy bread in the times of Mad Max, if those ever arise. um, it's durable, so it's not going to go away. It's not going to burn up in a fire. It's not going to disappear on you. Like gold is pretty much going to stay in existence, and it's portable. You can move it from one place to the other. Obviously, it's pretty heavy. So unless you have a very rare coin, which is cool, right? Like you could actually put $1 million. Well, now that last time I looked, you could find $1 million gold coins. I wonder what do you think is the most expensive gold coin?
I don't, I think $1 million sounds like a high mark for that.
Well, I bet you it's higher than that now, dude. I bet you there's a coin that's worth there you go, 18.9 million
Wow.
on Tuesday, June 2021. So think about how high inflation is since June of 20. So take that and add 10% easily, right?
Yeah.
So this is an exceptionally rare coin, the 19. So it's not just the value of the gold, it's the value of this coin itself. So you wouldn't want to melt this one down, right?
No.
You would cost yourself a lot of money. You wouldn't want to put a nick in it. You wouldn't. But here, this is what I'm trying to say is like, if you wanted to take $20 million, right, and just put it in your pocket and get on an airplane and fly to a foreign country, you're not even going to set off a metal detector with this coin. It's gold. It's not going to be the same, it's not going to set off a metal detector at the airport, for example.
Yeah.
So you could actually take $20 million with you anywhere in the world and nobody would know. And people say like that's a good reason to have Bitcoin because it's all on your cell phone and that kind of thing. But we've seen what Bitcoin has done.
I mean, somebody turns off the Wi-Fi, you're not getting your Bitcoin.
Yeah, arguably. I mean, I don't think they're going to take all the Bitcoin servers off. I really don't. That's not something that concerns me. But the point is, I mean, if I were looking at it, let's say Bitcoin. Oh, what the heck? Why can't I find the BTC USD? Can I really not add a comparison for that? That's too bad. Let me try one more time. Weird. I wonder what's going on. Really can't find it. Well, we'll just look at the futures because the short term is, oh, why is it not working? Sorry, guys, give me 1 second. I just want to show the comparison to what gold looks like versus what Bitcoin looks like. So we'll just use the futures. There you go. So yeah, I mean, gold is the blue area, Bitcoin is the orange. And so, you know, during say this time frame, Bitcoin first went up a lot. It was up 55%, while gold was only up 6%. But now Bitcoin is down 51% and gold is up 5%. So, you know, Bitcoin maybe someday will replace gold as a store of value, but you know, for the past several thousand years on the planet Earth, gold has been the #1 way to store value and protect purchasing power. And I think it's likely that gold will you know, remain in that position for a long time, again, because it's scarce, it's fungible, it's divisible, it's durable, and it's portable. And those factors are never going to change. That's exactly what makes it money. And when governments create money, when they create currency, that's what they try to recreate, right? They make it scarce by saying, okay, we're the only people who can print it, and they don't allow you to counterfeit it. $1 is the same as $1. It doesn't matter if it's the exact $1. It's divisible, meaning you can turn a $20 bill into $21 bills. It's not very durable. Some coins are pretty durable, but paper dollars aren't very durable. But it is always portable, and so you can take it from one place to the other. But again, you know, a briefcase full of $10 million is going to be pretty heavy, just like $10 million worth of gold is typically pretty heavy, unless you have one of these extremely rare coins. So
Absolutely.
anyway, that's enough about that. I'm sure we're running over on time. Do you know how much time we're at right now?
We should probably go maybe another 5 minutes and then.
Yeah. All right. Well,
Good.
I don't have a whole lot more. I mean, dollar is going up. No surprise that the dollar is rising. You know, we've drawn this chart before. So, you know, they raise interest rates, they send the dollars higher. People have to borrow dollars in order to get that US interest rate. And so, you know, that makes extra demand for dollars. And at the same time, like I think we talked about last week, they're taking dollars out of circulation for the first time pretty much ever.
Yeah.
So,
and then, you know, a lot of people too might be wondering, just as kind of one to finish up with, but how about mortgage rates? I know we hit on that one here and
first,
there.
just look at this again.
Oh, yeah.
So the M2, the stock of money in the in circulation in the world is actually ticking down. So we haven't got a new update on that yet. I think this is only a monthly series, so we probably won't get too many updates there. But yeah, mortgage rates are going back up. So getting a little bit higher. We got 5.23 is what we're seeing now. That's as of June 9th. So I don't know where we're at this week. Hasn't updated yet for the week in trading view, but I know it's not down here. It's not in the 4s. I think your average mortgage rate's probably even higher than what this is, because I think this is a pretty prime rate.
Yeah, and I think I've been hearing 30 years ticking over 6%. So
Yep,
it's getting expensive out there.
Yeah, over 6% is what I've been hearing too. And let's see, 30-year fixed rate mortgage. What can we get? What do you got to say about it, bank rate? National average 5.54. So most people are probably not getting that. I mean, that's the average. There are many people that are paying much more than that right now. So I don't know. Thankfully, I'm not in the market for a mortgage. You are? Have you been shopping one at all?
So I've been looking around. We have the good fortune right now of a little bit of time on our hands where we can hang out, but this financing at this rate, you don't want to take much out. This is a good time to just, you know, I'm starting to see a lot of houses take price cuts, and you're probably going to see more of that. If you can come in with more cash, less debt, you can probably find a nice deal coming up.
Yeah, I don't see the rates get materially lower, but I do see people lower in their price. So your overall payment can go lower, you know. But those two factors are definitely counter one another, and it's not getting any cheaper out there. So
Mhm.
I don't envy your position on that one. Yeah, so Bitcoin, you know, I know I pretty much nailed it when we spoke last time. I think we were drawing maybe on your chart, or I don't know if I was on a different deal, but I remember that we drew, you know, we drew a level there and we drew a level there. And I said that, you know, it's about 26% or whatever it was up to this level to get into, you know, this little consolidation area. And I said, when it falls out, it'll probably go down by another 26%, which it basically did exactly. And I said that there was a level right back here at the lows of this little consolidation period that would coincide. And so there we are. We're right back to where I thought we would get to. Bitcoin probably hangs out here for a while, maybe even bounces a little, but ultimately, my current target price, where I would get excited about maybe the opportunity of buying some Bitcoin, is down here at right around 13.8, which would be an 80% drop from the highs. So 13.8 there, and that would represent an 80% drop roughly from the highs,
Yep,
just over 60. Gosh, was that almost 70,000? Is that what that was? Holy
it
moly.
was.
Yeah, it was almost 70,000 bucks. So yeah, Bitcoin is in the hurt box. It's dropped by 80%, you know, more than once in its history. You know, looking back here, that was an 85% drop. That one wasn't quite as bad, but back here, when before Coinbase started keeping these, or was chartable, it dropped by 80% a couple other times. So, you know, it dropped by 80% here, and then, you know, proceeded to go up by 1,973%. So anything's possible. I think Bitcoin will not go to zero. I think it'll be a fun thing to try and catch when it does finally start going up, but I don't see any reason to get crazy aggressive and try and buy this thing here. I don't really see any reason to get aggressive buying much of anything. We're in
Nope.
a bear market. We're probably heading into a recession. The Fed is not accommodating the economy. In fact, they're doing the exact opposite. And all that just says be patient, hold dollars, keep the powder dry, and wait for better times.
Absolutely. No real opportunities to go picking bottoms right now, and just better to take your time away from the markets, go enjoy some life, and revisit this later. So
That's right. That's right. All right, man.
awesome.
Well, anything else you wanted to chat about, or did we get it all?
I think we got it all. So thanks again for your time, and we'll see everybody again next Thursday.
All right, later on.
See ya.